Thank you again for placing your trust in us. I just wanted to give you a brief update of the highlights on the investment situation over the course of the last 6 months, 6.5 months, today being mid-July. I would tell you that the highlights are equities once again were the lead horse. U.S. equities, large cap U.S. equities returned a little under 3% in the first half of the year, and through the first couple of weeks of July, we're looking at something closer to 4.5%. So it's been a positive year for the flagship index, the S&P 500. Our portfolios also reflect a fairly significant overweight to small caps. The small cap index actually was twice the return of the S&P 500, coming in north of 10%. So that's obviously helped the overall return of your portfolios. On the negative side, emerging markets has been a bit of a drag. It's been down about -4% for the year. And the core bond strategies on a total return basis are also showing a mildly negative return. Not surprising given that interest rates over the course of the last 6.5 months have ticked up higher as the Fed has continued to normalize rates. That's shorthand for increasing rates gradually to reflect a better tenor to the underlying economic fundamentals. So let me spend a little bit of time on the economic fundamentals. We're feeling very good about profit growth, which once you clear away all the noise, profit growth is the long-term determinant of whether or not bull markets continue. Profits are growing at a rate of 20% plus through the first 2 quarters of 2018. Some of that is the tax dividend, if you will, the tax cut from the Tax Reform Act that was passed in December. But in addition to that, there's true organic growth that's accelerating. We're seeing revenues grow 8, 9, 10% in some cases across many sectors, both service and manufacturing. We're seeing unemployment rate continue to drop. We're seeing employment participation increase. We're seeing wage growth beginning to firm up a little bit, albeit from a low base, but the trend is positive and accelerating. I think the punchline here is that we feel very good about having an overweight to equities at this point and an underweight to fixed income. We like that positioning. We expect it to continue going into the second half of the year. The non-U.S. part of the equity portfolio continues to be a source of concern. We're not complacent. We keep taking a very close look at it. We do have about 19% of client portfolios invested, of clients' equities portfolios invested in non-U.S. But for now, I think it's appropriate. But nevertheless, keeping a close eye on that. Overall, I would say feeling good heading into the second half of the year. And I look forward to having an opportunity to dive in a little bit deeper, one-on-one, in the coming meetings that we're going to be having to review client portfolios.